Kia ora, and welcome to the CoreLogic Property Market Update for December 2020. What a year. 2020 kicked off with strong growth in the property market. We then mostly survived the global pandemic, though it's not over yet. And we're finishing the year with yet again strong growth in the property market. This is perfectly visualised through the monthly change in the CoreLogic House Price Index, where we can see the main cities, provincial markets and rural towns all followed the same cycle. The rural towns proved the most resilient, but the provincial centres have seen the greatest rebound. Looking into the detail, it's notable that even property values in Queenstown are back on the up. I suppose the beauty of a place like Queenstown isn't negatively impacted by the virus. So once confidence had returned, and despite borders still being closed, buyers came back out of the woodwork, taking advantage of low interest rates and easily accessible credit. These factors driving the market have been well covered throughout the year. The government and Reserve Bank sought to guard against what could have been a devastating recession after having to go through various stages of lockdown, and they've succeeded. The flip side now is that all that assistance has helped too much, and asset prices are again rising at unsustainable rates, which is making the property market very political. Excess demand is one side of the equation, but perhaps the more important side is the supply side. Limited immediate supply, in the form of properties listed for sale, has existed because we never recovered from the strong sales of 2015-16, which ate into the total stock on the market. And this has never been replenished, despite listings coming to market at similar rates to previous years. Which brings to the fore the state of the new build market. And while we must acknowledge the record raw number of consents being processed, the build rate per 1,000 people is not at record levels. Plus, we're still recovering from a period of seriously low consents, meaning supply additions remain well behind where they need to be for our population base. Reform of the Resource Management Act, RMA, is on the cards, but serious moves need to be made to invest in infrastructure, reduce the cost to build, including encouraging off-site manufacturing, and incentivising the best use of land. None of this will be fast moving, however, which is why there's also pressure on making renting more favourable long term. And from an even broader perspective, we need to find a way to promote other forms of investment as a valid vehicle for attaining a comfortable retirement. Until we see meaningful change, things will continue as they are. And this means housing affordability will continue to be stretched, and the topic will remain a political hot point. The CoreLogic affordability measures clearly illustrate the improving situation for homeowners, but worsening situation for aspiring homeowners. It's more affordable to pay your existing mortgage at the moment, but harder to save up a deposit and stretch to the purchase price, especially while paying a greater proportion of your income on renting, and incomes aren't rising as fast as housing values. Not a great outlook for potential first home buyers then, and the CoreLogic early market indicators won't do much to quell those frustrations. Appraisals being generated by agents have already tailed off, meaning listings won't improve before Christmas. Yet, the banks remain very busy ordering valuations for mortgage lending. Perhaps this partly explains their ability to put in place their own loan-to-value ratio restrictions, or LVRs. It's easy to be picky when demand is so strong and turnaround times are lengthening. And there's no reason to think that next year won't start in much the same manner, once everyone's had a wee break. There must be some consideration of the impact of the LVRs if the 40% deposit requirement becomes more widely implemented or even mandated, as this has had an impact previously. But for now, the proposal for deposit requirements to be reinstated at the old levels, 30% for investors and 20% for owner-occupiers, albeit earlier than originally planned, now on the 1st of March 2021, are unlikely to have a meaningful impact, with enough demand remaining in the pipeline. We'll have plenty of content right up until then though, including our comprehensive look back at the year that was, analysis of the best suburbs and sales for 2020, and of course another episode of our Property Market Podcast. The research tab at corelogic.co.nz is the place to bookmark so you don't miss a thing. Have a fun-filled break, catch you in 2021, and good riddance 2020. Mā te wā.